you're going to have these nice counter trend rallies to reduce risk into, hedge your positions, raise a little bit of cash, kind of navigate volatility. And I think that continues to be the message here until we eventually kind of, get to a market low.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart, welcoming you here at the end of another week, featuring my good friend, the Rock'em Sock'em portfolio manager, Lance Roberts. Lance, how you doing?
You know what? I don't think many people in your audience are probably old enough to remember Rock'em Sock'em robots. So
yeah, I think most people probably do, or they will if they see it. And folks, I'll put a little picture up here on the screen. But yeah, Rock'em Sock'em, because right now that's sort of the theme of these tariff battles between the U.S. and China right now, and we're sort of stuck in this will they, won't they, push-pull, headlines back and forth. Trump thinks the deal's going to get done. China, no, we're not even talking. Trump, I'm going to put more tariffs on them. China, well, maybe we'll exempt some of your products. So it feels very much like, being opposite the table from your opponent there, clicking little buttons with your Rock'em Sock'em robots. Also, it's a nod back to your pugilistic MMA days, Lance.
Exactly. There you go.
All right.
Back in the day, before UFC actually made money. Sure.
Okay.
The legacy of my family was being professional athletes before they paid any money.
So basically, you're saying Conor McGregor owes you a big debt of gratitude for what he's made, and he should probably cut you some slice of his winnings.
He should definitely cut me in, just like my dad was a professional tennis player back in the 50s and 60s with Pancho Gonzalez and those guys, and he had to hitchhike his way to tournaments to get there. And now, these guys are making millions of dollars a year playing tennis. So
you played for like a $50 pot back then.
Pretty much the case, yeah. So it's just interesting.
Wow, Pacho Gonzalez, that's a name I haven't heard in a long time.
And like I told you, it's like, back in the days when we had to fight dinosaurs on the way to school. So it's funny, I was doing that just real quick. I was doing an interview with Charles Payne on Wednesday of this week, and he put up this chart. He said, in the 22,252 trading days since 1929, the number of stocks that traded positive in one day has only occurred like 7 times in that period. So when he came to me, he said, Lance, what do you think about that? I said, well, having lived through all those days.
We call that seasoned experience, right?
Correct.
That's the right way to spin that.
So real quick, I got an email this week that was, questioning our conversations that we have on the show is like, oh, it's all pre-scripted. You and Adam have had these huge discussions, beforehand, and have mapped all this out. So y'all have this debate that goes on. And I just, you don't tell me anything when we're on this show. I don't know what you're going to ask me or where this thing is going. We're just having a conversation. So, because it's because the joke with you is like, oh, I wrote an article about that. Well, the reason I wrote an article about that is because you told me to write an article, and that's not the way this works.
No, it is anti the way this works, which is why I laugh. Not only do I not prepare you, Lance, not only do I not even know what we're going to talk about until I create my list, like 5 minutes before we get on air. But I know that if I tried to reach out to you, you wouldn't even listen to me. So
probably.
No. So folks, what you see here on this show every week is the sausage getting made in real time. So look, the markets have, recovered a little bit, right? We've had about a 5+% bounce or so from the latest bottoms.
Yep.
And Lance, you have said that you think we are in an environment where it's going to be more of a sell the rip type of environment here. So, A, is that still the case in terms of your outlook? And B, how far does the rip need to go before you start taking stuff off the table?
Well, so first of all, let's back up a little bit. First of all, I've already taken stuff off the table, right? On that previous rip that we had, right after Trump paused the tariffs for 90 days, that morning we had bought a bunch of technology stocks, et cetera. And then on that rip we had that afternoon, after he made that announcement, we took a bunch of that stuff back off. So we raised about 10 to 12% of the portfolio in cash. We also added a short position to the market as well. Probably today, after I get off the air with you, I'm going to add to that short position today. I guess we can just go ahead and jump to a couple of the technical charts here real quick, because there is a, again, I'm more optimistic, and you and I talked about this last week a bit. I'm more optimistic about the markets starting probably August, September, going into the end of the year. I think we're gonna have a fairly healthy market at that point, and then heading into 2026, barring the onset of a recession. So as long as we don't have a recession, the markets are set up pretty decently for a decent year-end rally. But between now and then, I think we're going to have a lot of chop and slop through this. So kind of, and we've kind of laid out this premise over the last 2 months. I probably started writing this about 2 months ago, that again, we go back to January the 7th, we wrote Curb Your Enthusiasm, why this year was going to be more volatile. And then about 2 months ago, we started laying out this premise that this year could look a whole lot like what we saw in 2022. So this is a couple of tweets that I put out this morning. So now, Adam, you and I are discussing this Friday morning, and as we sit here right now, the market's down about 44 bips, about half a point or so. Nasdaq's down a little bit. Google's having a really good day today. Amazon, the kind of the big mega caps. Google had good earnings last night. But again, we're starting to see some profit taking in here, and that's not surprising. So, and the fact that it's such a mild kind of profit taking today and volatility is not spiking, that's really encouraging portfolio wise. But so what's happening now in the market is not reflected in this chart. This is yesterday's close on Thursday. Two things, a couple of things happened this week that are optimistic short term here. Is that on Wednesday, we broke above the 20-day moving average. Now, that's just a very short-term moving average, but it's positive that we got above that first level of resistance. Then yesterday, on Thursday, we broke above that downtrend line that's running all the way back to the February peak. So we've had this consolidation of prices. We've this, these higher lows, and now we've broken out of that downtrend line. But as of this morning, we ran right into the resistance level, which is that kind of dotted dash line you see here. That's those lows, that kind of double bottom the market put in earlier in kind of mid-March and late March, where the markets were okay with 10% tariffs. We'd had this correction in the markets. Markets were down about 10%. Markets were coming to grips with 10% tariffs. That was going to be okay. And then, of course, right after that was those two huge down days, which was when that Wednesday and Thursday, when Trump came out and announced the tariffs being based on trade deficits rather than reciprocal tariffs. And that just really kind of pulled the rug out from under the market. So, we're now rallying back to those previous bottoms. So those previous bottoms are now resistance. We've got to get above that in kind of a short-term basis. And I don't expect that to really occur here. We could see a little bit of a pullback here, retest that downtrend line, and then if we can move above that resistance level, we're going to immediately run into the 50-day and the 200-day moving average right above that. So there's a lot of work the market has to do. Now, on the bullish side, we have a MACD buy signal short term here, so that's positive. That's giving that's showing we've got some momentum coming into the markets. Investors are investing capital. That's good news. Relative strength is improving. That's good news. And so we kind of want to see that continue here. And that kind of gives the market some support, at least in the near term. Now, as I was talking about, though, is that this year is really kind of tracing out what we saw in 2022. So I've rebased the market to 100. And, this is an overlay of the current year-to-date performance of the market through yesterday. Versus 2022. And you can see we're kind of just, following that same kind of, tariff war, Ukraine, Russia, Fed hiking rates thing that was going back in 2022. We're doing that with the whole trade war now. So again, you can expect to see this bit of a rally. Could it go a little bit further here? Sure. And let me just quantify something. I hate analogs. I think analogs are the worst thing ever. But my point with this particular graph is to show that even if you're expecting a larger market decline, which I'm not expecting us right now to go set new lows in the market. I think we can retest lows most likely, but while it's certainly possible, the amount of negativity and lack of positioning in the markets is probably going to use the previous lows as the low for the market to test, at least over the next couple of months. But it could set new lows. But even in that type of environment, you're going to have these nice counter trend rallies to reduce risk into, hedge your positions, raise a little bit of cash, kind of navigate volatility. And I think that continues to be the message here until we eventually kind of, get to a market low. This chart overlays. So in our weekly newsletter that we post on Substack as well as our website every week, we have a technical gauge in there. And that technical gauge is a weekly gauge of technical analysis comprised of 13 different indicators: stochastics, relative strength, MACD, etc. We combine all those together to create a score. And since that's weekly data, when that weekly data gets extremely oversold, it's generally a really great time to start looking to add exposure to your portfolio. And that's kind of what we started doing a couple of weeks ago. We bought some energy stocks. We were added to our tech stocks previously, because when you have that kind of negativity in the markets, you're going to get a reflexive action in the markets at some point. So you can see that we're even tracing out that technical basis exactly like we were back in 2022, which again, we've got room for that to improve here a bit more. We're not overbought in the market yet, but I suspect that we'll get there over the next week or two. If we continue to get some good news here, there's enough pent-up demand to kind of push asset prices higher. But then you're going to have all these people that got swept up into this sell-off, and they're now, it's what we call trapped longs. They were long the market, everything was fine back in February, and all of a sudden they wake up one morning and they're down 15% in their portfolio. They're just looking for an exit. So you'll get this rally, you'll get this exit, you come back down, kind of start setting that market low, and then that's where you can, and once you have that retest of lows and kind of wash out that sentiment once again, that's really going to be probably the best opportunity to start really kind of rethinking your portfolio structure, adding your equity risk, reducing bias to risk hedging, and moving back to a more aggressive posture.
Okay, so a couple of questions on that. So one, you said you think we're going to be in the chop until maybe August, September timeframe. That's again echoing what we saw here in 2022, right?
Right.
Okay. And by the way, just kind of spooky so far how that correlation is. And I know you don't love correlations, like you said, or analogs, but it is pretty
correlations. I love analogs, not so much. Okay. Well, the only reason I'd say that, Adam, is that you see a lot of these analogs running around. It's like market's doing this, and so we say, well, this is just like it did in 1929, and or the market's doing this, and this is just like it was in 1995, and markets are different, the backdrop's different, economics are different, and those analogs never last very long, and they break pretty quickly. And so they're great for headlines and create, if I'm trying to create a fear headline and go, yeah, this peak is just like it was in 1929, right? And so everybody goes, oh my God, the markets are going to crash. But generally those things, we don't have the same economic backdrop. We don't have the same fundamental backdrop. We don't have the same monetary backdrop. And so the outcomes are likely going to be very different. So that's what I'm saying. Just be really careful of analogs because they tend to break in a very short period.
Okay. That said, it looks like you are looking at, you're not necessarily looking at the correlation there and saying it's exactly going to repeat, but you said, look, when the market gets real oversold, that's when you want to start, adding to your positions, which you did when it got real oversold there on the chart. As it starts to recover, you have the trap longs issue that you just described. So you're expecting that to happen next if the market keeps rising from here. You're nodding as I'm saying this. And this is what happened in 2022 too, around the same time. Right. And so then you're expecting the market to then go down again, maybe retest the lows, who knows, but go lower. And is that why you're putting on additional shorts maybe later today?
Yeah, okay. Absolutely. We've been building in a short position and raising cash. Even though we knew this rally would come, we've still used these bounces like we had previously. We had that big 9% day, and we used that day to raise some cash. And then the market sold off the next couple of days. And I think we're just going to continue to see that process. So we just kind of continue to build this hedge in the portfolio. So like year to date right now, our portfolios are flat on a year to date basis. So,
versus the S&P, which is what?
Is down. The S&P is down 6.5% for the year.
Okay.
Right. And again, that's, everybody goes, well, the market's down. The market was down 20, but yeah, but remember that 20% draw started from the markets were up like 5% for the year before we had this draw, because the markets were actually doing well earlier this year. So year to date, the S&P is down about 6.5. We're flat at the moment. And so, I'm okay giving up some performance here because I've got a gap over my benchmark. So I can be a little bit more risk conscious. And because I'm still outperforming my index, I've got a little bit of wiggle room here that I can allow the markets to catch up with me, ensure that, we're back into, that we've finished this correctional process. And then I can take all the hedges off and just go back long markets and then go from there.
Got it. Okay. In terms of hedges, you've got the short, you're going to add to it, like you said. But you also have reduced equity exposure right now, right? So even though you've been buying in, it's not like you're back up to 100% of your equity potential, right?
Right. No, most of our, when we're buying, a lot of times that we're buying, we're not actually increasing equity risk. We're shifting equity exposure.
So you're selling something to then buy.
Right. Yeah. So like we trimmed AbbVie as an example, because it was 5% of our portfolio. We trimmed it down to 4%, and then we bought energy stocks. This was 2-3 weeks ago. So we're not really increasing our equity exposure. We're just rebalancing where that equity exposure is. So energy was extremely oversold. Those stocks were extremely beaten up. They were going to bounce, and so we just basically took something that was overbought and then bought something that was oversold.
Okay. I'm going to ask you in just a minute about what we're learning from earnings season so far, because we're now beginning to have earnings reports. Real quick, though, just back to kind of my rock'em sock'em comment. It feels like we are sort of trudging our way through this interim period where what's probably going to drive the action in the short term more than anything else is going to be the headlines, largely around the trade war. Oh, absolutely. Okay, great. So just again, expect sort of unpredictable volatility here, because we just don't know what tomorrow's headline is going to be. And that's going to, again, maybe overcome more fundamental things like earnings expectations and stuff like that we're hearing the CEOs release during their earnings calls. Okay, so you've just confirmed that.
Well, one of the things, huge thing, is don't forget that buybacks start week after next. Okay. So one thing that's been completely devoid of this market over the last 3 weeks, while we've had this whole trade war mess going on, is that corporate buyers have been out of the market. They've been in blackout, and so we had Google today. Next week we get Microsoft, Amazon, Apple, and we've already had Tesla. So all outside of NVIDIA, which won't report until the end of May, you've got all of your Mag 7 reporting next week. So that, and remember, the small and mid cap companies, they're not doing stock buybacks to any great degree.
Right.
The ones that are doing stock buybacks are the big corporations, the Apples, the Amazons, the Googles, and just announced a $70 billion stock buyback. Those are the ones doing it. And so for instance, Google, now that they've announced, they can actually start buying back today. But after next week, that window almost fully opens for all companies.
Okay, so that's a potential additional force coming into the market, and not even really a potential. I think we can count on it, and Google is showing why.
It's a buyer for sure.
Yeah, and so that should help firm up the market. So I know it's only been the minority of companies so far, but are we detecting any trends yet in the companies that have reported?
I will tell you two things that shocked, I tell you, actually shocked and amazed me over the last, really week in particular. And I'm going to see if, while I'm talking here, if I can find this chart that I posted earlier this week. But so far, look, nobody's really paying much attention to the earnings at this moment. And the reason is that it's all first quarter, and these tariffs really didn't start until the, kind of really in the second quarter. So we're not going to see the real impact of tariffs on companies until really we get in the third quarter. But overall, companies are beating estimates, but that's not surprising because we cut estimates going into this quarter anyway. So, it's just the typical lower estimates. We beat them all, but the guidance hasn't been terrible, right? Now, two things. One, we've seen a lot of companies like Walmart withhold guidance because they're like, we just don't know. So I'm not going to give you guidance right now because it's just, there's too many things in flux. I just can't give you guidance here. Makes complete sense. But but we've actually gotten more guidance from companies than actually we expected coming into this. And it's not the end of the world, right? Everybody was expecting that tariffs were going to be this massive, impact to the US economy. But most companies going, yeah, we think we can pass some of it on. Good example was Home Depot. Home Depot said they're going to raise prices by 5%. Now think about that for a moment. They're going to raise prices by 5%. That's inflationary. But hold on a second. The tariff on most of the products, let's just say we have the minimum tariff right now, which is 10% for 90 days. That means Home Depot's eating half that tariff. So there's two facts that are coming in, and this is something we'll have to see over the next couple of quarters, is how many of these companies can actually pass on those tariffs. Because if they have to eat those tariffs, remember, the only people that pay tariffs are the producers and the service providers. They're the first ones that pay it. It's a tax on them. The question becomes, can they pass that through to their actual end consumer? But then we have to talk about the status of the consumer, which it ain't great right now. I mean, savings are running out, credit delinquencies are rising. We've talked about all that. We wrote that article last Friday about the consumers tapping out. So the real challenge, and again, and I'm about to get to the amazing part in just a second. My expectation is that forward earnings guidance is going to have to come down substantially, right? Tariffs are a tax. If you can't pass that tax on to the consumer, it's going to impact earnings and corporate profitability. Right now, everybody's still assuming that these companies are just going to, be able to pass 100% of this on to consumers. And I highly suspect that is not going to be the case. And that's where tariffs become deflationary, because we had a lot of companies run out. They bought a bunch of inventory prior to tariffs. So now they got this inventory build, and they're expecting to pass that on. Well, they paid a high when all that demand was going in. We had those big surge in imports. That was supply demand imbalance. They overpaid. Those prices went up, and we saw that in the ISM prices paid as an example. We saw a big jump in ISM prices paid. That was because of the demand. You had a lot of demand, no supply, prices go up. So they overpaid for that inventory. Now they've got that inventory in the books, and they're going, okay, I'm going to sell that to the consumer. So Adam goes, yeah, I'm not paying that. And they go, well, what would you pay? I'll pay this. And so now they have to start cutting those prices. And that's where taxes on consumers become deflationary in the economy. And that's what we'll see later this year. And that's going to impact earnings. Now, here's the amazing part. I just pulled, as you know, I track S&P earnings. And I get the S&P earnings data from the purveyor of the S&P Global Index. So the S&P Index is created and managed by S&P Global. Go to them, Sam Stovall, who is their analyst for S&P Global. He's the one that produces all of the earnings estimates for the S&P 500 index. So FactSet, they do their own thing with analysts. This is from the company that drives the S&P itself. And I'll share this with you, but this is quite amazing and really jumped out at me last week, because not only did S&P, this is as of April the 15th, this is the latest update on their earnings. They not only raised their estimates for 2026 from 283 to 292, that's a brand new record for that. They've also raised earnings estimates for every quarter between the second quarter and the end of next year. That's the red line here. So what S&P is saying is they're seeing absolutely no impact from tariffs on corporate earnings, at least at this point. Now, I will tell you this, those estimates are going to come down, and they're going to come down a lot next year, because again, we'll get into the whole, we're going to cut estimates before the quarter thing. So, we'll see those estimates come down as economic growth slows, and that shows up in the data. Those estimates will come down. as we get, if we start to approach a mildly recessionary economy, which is certainly possible, those estimates are going to come down sharply.
That is really interesting. Yeah, they see basically no impact from tariffs, and they see no impact from a recession. And look, either one of those things the prospects could improve from here, right? We might avoid recessions. The tariffs might all get taken off for the most part. Um, but that's interesting because one of the things I was going to talk to you about is there's a headline this morning: Wall Street's biggest bull capitulates, which was Deutsche Bank, slashes its S&P target from 7,000 to 6,150 for the year. So I saw that and was thinking, oh, well, look, analysts are finally beginning to bring down their earnings forecasts, but sounds like you're saying the folks at S&P aren't.
That not yet. And again, I look at their data because they're the ones that build the index. So that's the one you want to track off of. But there is, outside of that, if you take a look at Wall Street's estimates, those are coming down. We've got a fairly negative earnings revision going on of expectations by Wall Street analysts. It just hasn't filtered through to the index purveyor yet. And again, it will. But I was just kind of shocked that I had pulled data back from March, and we'd seen a slight decline in forward estimates. So I'm like, okay, that makes complete sense.
Yeah.
And then I pulled April 15th and they jacked it up. Like, what I don't know who's smoking what over there, but yeah. They're very bullish right now. So,
well, square one thing for me. So you believe you're quite confident that those estimates are going to get walked down as we get more data as we go further into the year. You also mentioned earlier that you feel, so right now at least, you feel like the market's going to, turn upwards in the fall, right? So are you expecting that walk back of estimates and any markdown of stock prices to happen between now and the fall?
Yeah, well, part of the answer is yes. As we get into quarter three, quarter four, those estimates are going to, for quarter three, like as we start to approach each quarter, right?
Yep.
We start seeing those estimates cut. As a good example, interestingly, this is, kind of what happens at the beginning of every single quarter, because what we see, and again, when you're talking about forward earnings estimates right now, they're very optimistic, but like, for instance, here's the quarter one 2025 estimates from March of last year when they first announced it. Then they raised it, and then they started cutting it, and it's been cut going into this quarter. So we went from an expectation of 226 in the first quarter down to 217, and those are the numbers that we're beating now. Second quarter has already gone from 234 to 225, and that will probably go lower before we get into the June reporting period as well. So, and that's what I'm saying, is that every single quarter, this is what happens. So when you start looking forward and you say, okay, you're predicting 293, by the time we actually get there, it'll be marked down to 275, 280, whatever it is. But the markets will have already adjusted for that. So market dynamics don't necessarily feed directly into earnings revisions because these happen very slowly over time. And the markets don't really pay much attention to revisions. All they care about is, right now, I'm looking at forward earnings. And if I'm looking at forward earnings on a PE basis, we've had a very sharp reduction in valuations. We've gone from basically about 25 times forward earnings to 22, which is the median valuation going back to the turn of the century. That makes you feel old. But, so we've reduced valuations a lot because the P's come down, but the E hasn't to any great degree. And that's what will happen every quarter. We'll start pricing out. And even though they're bringing down the near-term quarter, that long-term quarters, the long-term projection is still sitting out there. And that's what they're basing expectations on. So they're willing to buy stocks at lower valuations based on that forward earnings, even though they know that ultimately that forward earnings number is going to come down. But nobody cares about that because we're always looking at the next quarter, right?
Yep. Yeah. All right. Well, let's differentiate one thing for viewers too, just to make sure folks get it. So, let's say, tariffs are a part of the future, right? I just want to quickly describe the difference between an inflationary trend or an inflationary era and a price shock,
Right.
right? Basically, a price shock is a one-time event. Hey, we slapped a X% tariff, on this product from this country. So the price of that product will jump, and it'll jump depending on how much of the seller eats of that tariff versus how much they feel they can pass on to the consumer, right? So the
Right.
bad news is yeah, we're all pretty bruised from the jump in cost of living that we've seen post COVID. Yeah, we might get another jump in the near term from tariffs, but it is not likely to be an inflationary trend, right? It's just a one-time repricing. So in theory, then if the tariff doesn't change, pricing should flatline at that new price, right? And I know nobody likes an increase in price, but in theory, it shouldn't continue to increase which it would do if we were in an inflationary regime.
Right.
Now, there are some people that I interview on this channel who still think that inflation is going to be sticky and be higher and last longer than folks imagine. That's a different factor. But don't think of tariffs as inflation. Think of tariffs as price shock.
Right. And again, the one thing that, most of the kind of the inflation kind of narrative is coming around is like these tariffs are going to be massively inflationary, right? Because, they're assuming that, if we put 150% tariff on goods coming out of China, that, well, consumers are just going to pay 150% more. And if that was truly the case, that would be very inflationary. The one thing that
Well, to be
economists,
clear, it'd be very shocking price-wise, but it wouldn't be inflationary. Yeah.
well, no, it would. And so assuming that it would just stuck, right? Just this
Yeah.
is this, for instance, let's just, in theory, every product on every good in the world has 100% tariff on it. It doesn't matter where it comes from, right? So yeah, everything's going to go up 100%. That's inflationary. Now, how do we measure inflation? So this is to your point. If the price of, let's just use the price of gas because everybody pays for gas. I pay $3.50 a gallon, or say I pay $3 a gallon in Texas for a gallon of gas, and a year from now it's still $3 a gallon. There's no inflation,
Right.
right? Because we measure inflation on a year-over-year basis. So, but what most economists and where most of the kind of your mainstream analysts are wrong about tariffs is they forget about consumer choice. Consumer choices are simply the function that I don't have to buy that product. If it's marked up 100%, I don't have to buy that product. I'll go buy something else. And when you apply a tax to consumers, that's exactly how they respond. They contract spending because they already can't afford the cost of living for where it is. And we know that data is already coming through. And so their ability to pay higher prices just simply isn't there. They're getting cut off on credit lines. They're delinquent on their debt at this moment. So they're just simply going to have to cut back, and they're running out of savings. They just simply have a choice. And then at that point, then the producers of the goods or services say, well, I've got to sell something, because if I don't sell something, I'm going out of business. We're going to cut prices. And they're going to cut prices in order to sell a product. Because again, at the end of the day, it's always and everywhere. It's not about the dollar. It's not about the deficit. It's not about the debt. It's about supply versus demand. That's the only thing that drives inflation.
Yep. So let me ask you this then, because you expect the economy to continue to slow, maybe go into recession, maybe not, but to slow, right? Why does that make you, or sorry, why are you optimistic about the stock market's prospects in the fall if we're kind of falling into a slowing economy here, meaning demand is shrinking?
Well, so two things. First of all, I'm not like ragingly bullish. So
Okay. That's good to clarify.
yeah. I just think, and again, this goes back to what we wrote about at the beginning of this year, is like expect a year of volatility. And markets are driven just like everything else on supply and demand. And when you drain the demand out of the market, there is going to be a point that regardless of what else is going on in the economy, money's going to find its way back. And you and I talked about this last week, is that every asset class is a liquidity source for another asset class. Mm-hmm. So when you have one asset class that's absorbing all the inflows because everything else kind of sucks, when those get really washed out, there's going to be really smart investors out there that go, you know what? There are some stocks trading. Doesn't mean the whole market. And this is the one thing about investing that everybody needs to learn very quickly. don't look at the market. The market is not a proxy for investing. You look at the companies that make up the markets, and even in bearish markets, there is always companies that are very undervalued fundamentally, that are providing opportunity, and investors are going to find those, and then they're going to say, okay, I was hiding money over here in this asset class because it was going up while these were going down, and now there's a real value over here, so I'm going to take money out of this asset and I'm going to go buy this asset over here. And we saw that this week. We saw that rotation between asset classes this week. And that's going to be, as we get later into this year, we're going to continue to probably wash out this market. We're going to wash out retail investors who have been really very, very bullish so far. We haven't really wrung out a lot of the retail sentiment yet. The speculators have been, 0-day options. They're going crazy on leverage, ETFs, et cetera. We need a couple more washouts in the markets, but we'll wash them out. And then regardless of what's going on in the economy at that point, markets are going to start to find a base and then start to recover ahead of the economics. So, again, we're taking a look at the markets right now. The markets are predicting slower economic growth. That's what's going on right now. And at some point, even though we're right in the midst of the recession or right in the midst of a real strong economic slowdown, the markets, again, are going to look forward and they're going to start going, this is going to be over. And then I want to be on the other side of this ahead of time. And they're going to start buying, even when it seems to be the worst, you're going to see investors coming into the markets. But again, this is tomorrow's newsletter, which I'll post on Substack in the morning, as well as on our website, is talking about being a Vulcan. And I went and I asked ChatGPT for give me quotes from Spock that relate to investing. And it gave me like 5 or 6 really good quotes. So I wrote a whole article using quotes from Spock about how it relates to investing, and then tied that to people like Warren Buffett, Benjamin Graham, et cetera. But you're starting to see those opportunities starting to create themselves. So I'm optimistic about the end of the year, because I think we're going to wash a lot of this stuff out around September, October-ish, maybe. Could be a little bit later. It could be early next year. And we'll just have to navigate this. But within the next 12 months, these markets are going to find a bottom. Okay.
So let me repeat that back to you to make sure I really understood it, because there's 2, I think, really important things you mentioned. One is you see the economy this year slowing, maybe goes into recession, maybe it doesn't. But then it is going to turn around, right? Mm-hmm. And I mean, economic cycles, it's just how economies run, right? But you're not like, oh gosh, we're going to spend the rest of the year falling into recession. We're going to spend 2026 and half of 2027 stuck in recession, and then maybe we'll come. You're seeing right now, based on your best estimates, this is something that you think will be turning the corner of either near the end of the year or in the first half of next year, right?
Right. Yeah.
Sorry, let me just get the second point, and then you can.
Okay. Sorry. Yeah.
Okay, so that's your forecast for the economy. Your forecast for the markets is that we're going to get to a point of capitulation where the speculators have finally been burned enough where they're going to say, I'm out, right? I'm not touching this thing, right? So to me, that means pain. Like, it's going to be painful for a lot of investors between now and whenever the markets sniff out that the turn is coming, because to get to that capitulation, you have to pull the rug under the optimists again and again and again so they stop being bullish.
Right. Well, so let me do the second question first, and then you'll probably have to remind me of the first question, because I'm old and I forget.
No worries.
But so when I'm talking about those people, and when we're talking about those retail speculators, that's that group of people that really have only been investing in the markets for about the last 5 years. And what they've seen is, post-pandemic, post, 2022, is that markets always rally. And the more aggressive I am on buying the dips, the better I'm rewarded. And in fact, I am writing an article for Monday, talking specifically about this. And when you take a look at that retail speculation, they've been rewarded for doing that over the last 5, 6, 7 years because of zero.
6, 7, how about 17 years? I mean, really, since we came out of the great financial crisis, it's been a buy the dip era.
Remember, most of the people that started investing, they didn't start investing until about 2010, 2011. So that group, that kind of age group, they're very young and they've never really seen a bear market yet. and so they've just learned that the more speculation is, the better. So they're taking on all these leverage bets, leverage ETFs, et cetera. It doesn't take much of a decline to get wiped out of a leverage bet. And so like for a lot of those investors, markets down 20% peak to trough, they were down 30 and 40. Remember, we were talking about buying MicroStrategy, the 2X MicroStrategy long and all that. Right. Was just, that was going to be a bad bet. And it turned out to be a horrible bet. But that's just, they've got to learn that lesson repeatedly. So it doesn't take much of a decline to basically kind of wipe them out of leverage positions, particularly when they're on margin, et cetera. So for the more average investor, right, the mom and pops, you can take a look at the American Association of Individual Investors. They're very bearish. Allocations are coming down. They're very bearish sentiment-wise. Professional investors have very deep reductions in asset allocations. They're very bearish on the market. Look at the National Association of Investment Managers. It's down in the 30s right now. So those guys have pretty much already been wiped out that wiped out's not the right term. Their sentiment has been reversed to a large degree. We just haven't brought out all of the retail speculators yet. And that's then again, another 5 or 10% decline from, wherever this peaks is, maybe puts us back down around the lows. That's going to be enough to pretty much get them to give up at some point. And we'll see that retail sentiment back up.
Okay. So this is the crux of my question. So do you really think just one more, retest of the lows that's the washout and those guys are forever burned? Not forever burned, but burned enough to change their sentiment? Or is it going to require a couple of, or even more rug pulls before they stop looking for the bottom and, okay, this is the time to jump back in and just finally say, all right, forget it. I'm clearly not doing well here.
Yeah, that's why I think it takes till October. Maybe it's one retest of the lows. One thing we know for certain, this is the one thing we know for certain, technical analysis wise, we have a pretty clear history that markets don't bottom the first time on a correction. So you have at least a retest of the lows, if not setting a new low. And if not one test of the lows, at least multiple retests of lows. So again, that's why I'm saying is that, between now and October, I think there's going to be enough of this back and forth volatile action that it just wears investors out. And look,
but that's exactly what I was trying to get from you, which is folks watching this video, just expect what to many will be a frustrating, 6 months, basically. Yes. Yeah.
Yeah. And again, and look, I'm seeing this with my clients, right? I mean, I had a conversation with a client last week and he was like, Lance, just now mind you, his portfolio is flat for the year. The market's down 6.5. He was like, Lance, just put me all in cash for now. He says, I just can't take it. I know the headlines and the market's up and down. So I'm like, but your portfolio is doing fine. He's like, yeah, I know, but it's just all over the television, right? It just was weighing on him sentiment wise to the point that it's just like, get me out of the markets. And again, there's no reason to get out of the markets, but again, emotionally, we get so invested in, watching a YouTube channel or the financial media or reading whatever it is. And it's just doom and gloom and terrible. And, Trump did this and Besant did this and China did this. And people just go like, just get me out. That's what you want, right? To get to a market bottom. And we're getting there, but it's going to take several more months of this. And that's what we're saying, with the Curb Your Enthusiasm article, is just expect a year where we just go up and down a lot. We don't go anywhere. It's going to be very frustrating. The goal for this year is just to survive it. It's not to make money in it. It's just to survive this year without making a big emotional mistake with your portfolio. And then next year we should be in a lot better position.
Okay, great. And I just want to underscore, we mentioned this last week, but Felix Zulauf, very, very similar outlook, right? Basically, your job right now is just to keep your powder dry and be positioned so that when the coast is clear and you can get a chance to go long at decent valuations before the next bull run, that's when you want to really load up long.
Yeah. And look, and be really clear here, right? The big mistake that a lot of investors are going to make is they're going to be looking at the market and saying, well, the market's not a good value yet. But there's going to be a lot of companies that are going to reach really good values before the market does. And that's why you're going to have to be much more adept at really understanding what you're investing in, and looking for companies that are deeply, grossly oversold, that are at a good valuation, that are starting to bottom early, because they will, and money will start finding them sooner than later. So your job is really this year is you're going to have to really start to become an analyst for what you buy, rather than just looking at the overall market and making big portfolio decisions based on the overall market.
All right, great point. And again, pretty much exactly what Felix said as well, which is, keep your powder dry, but use the dips during this volatile period to start getting your entry positions on the companies that you're most interested in owning, and obviously they've got to be hitting really good valuations during the dips to make that worthwhile.
Right.
And this again too just goes to something I've talked about with a lot of the experts on this channel, which is just the best thing you can do for yourself as an investor in general, but especially in an environment like this, is just be honest about what your strengths are and what type of investor you want to be. Are you an experienced DIY investor who knows how to handle volatility? Great. This should be a phenomenal market for you. Lean into that skill. I will say, probabilistically, small percentage of people watching this video fit that that mold. And so you either want to be just very conservative, right, and just focus on keeping your powder dry and waiting until the sun comes out, or to Lance's point, if you want to become an active investor to ride this type of market, which really suits the active investor, great. If you are an experienced one, leverage those skills. If you aren't, don't pretend to, right? Don't take that risk learning on the fly with your hard-earned capital. Find somebody who is good at an active investor who can, basically play that role for you, be your active financial quarterback for you. So again, I don't care at the end of the day what you decide to do as an investor. I just want it to be the right decision for you. And that all starts with being honest about your skills, your goals, and how you want to tackle this. All right, Lance, let me move on here because we got a lot of wood to chop still. Somebody asked for a TLT update.
Yes.
I think specific to TLT, but can you just give us an update on where are things with bond yields, what's happening with credit spreads,
Sure.
and then the actual TLT trade, because I know we got a lot of people who watch who are in TLT. What should they be thinking given this environment?
So first of all, it was like, we talked about over the last couple of weeks about the whole basis trade, kind of blow up issue. And that seems to be getting itself resolved without any.
Which Scott Bessent said would happen. So kudos to him if that's indeed happening.
It's getting resolved on its own, and we're starting to see some decent money flows coming back. And it's funny. I posted this tweet this morning, and I'll share this with you. So I posted this chart. This was from Bank of America, and it shows basically the 4-week money flow into U.S. Treasuries, which we've had the largest 4-week inflow in U.S. Treasuries on record going back to 2023.
Wow. Does that break it down by who's buying, or is that just total gross flows?
I'll get to who's buying here in a second.
Okay.
This is gross flows. So my comment.
Can you expand that just a little bit? It's a small
Sure.
chart on the screen. There you go. Thanks.
So my comment is nobody wants to buy U.S. Treasuries. And of course, that's tongue in cheek from being sarcastic about that. Well, all these people were responding like, yeah, you're right. Nobody wants to buy them. I'm like, okay, you're an idiot. But the point is that we are certainly now starting to, find that point of where it seems as that whole kind of basis trade issue has worked itself off. All that margin deleveraging has been resolved. And so now they're starting to put the treasuries back on their books again. And just from a technical basis, I'm actually getting very, very close. We reduced our EDV position in our portfolio when that basis trade started because we just didn't know how bad that could potentially get.
Sorry, tell people what EDV is.
It's like TLT. It's just a longer duration.
Okay.
It's like 30-year treasuries versus 10 years. That's just different durations. So this is the 10-year treasury bond, or here's TLT. We'll just use it as a proxy. Price has been rising nicely. We formed a higher bottom here. And this is why I'm starting to get a lot more encouraged here to add back to my longer duration bonds. I'd shifted short duration, go back long duration. We're about to trigger a pretty decent buy signal. So last time we triggered a kind of a buy signal from this level, you had a very nice rally in bonds. And if we can clear, we're running into a big cluster of resistance here. So there's a bit of short-term risk. But if we can clear that resistance level, we should start to push back up towards 92.25-ish on the 10-year Treasury, which should put yields back around 4%, which is where they should be. Yields right now should be around 3.9 to 4% based on economic growth, wage growth, and inflation. So without any big reversal in inflationary pressures, which right now we don't really kind of see that in the cards, considering what's going on with oil prices, et cetera, you should start to see the bond market start to heal up here from that whole basis trade event and start to trade more normally. Now, it doesn't mean that, interest rates are going to go immediately to 2%, but as the economy continues to slow, yields should continue to come down to track economic growth and inflation and wages, which are all slowing. So as those continue to come down, we should see an improvement in the duration space of longer dated treasuries, and they should start to perform better. Plus, there's the big kink in the yield curve between 10s and 30s that will resolve itself as well. And that was because of that basis trade blow up, that kink kind of showed up, and that'll resolve itself, and it is resolving itself. And so we'll get back into a normal kind of a trend between the 10s and the 30-year treasuries.
Okay. Folks, we'll keep tracking this week after week. It would be nice to see some relief happen on the bond side here. Obviously, not only do investors want it, not only do retirees want it, the administration badly wants it, right, to get down its borrowing costs. And that's I think, I know, Lance, you think economy is going to slow, inflation's not going to be a big issue, like all those things are going to bring yields down, which I understand that logic. I also just think you have like the, what do you want to call it? The put, the Trump put or the Bessent put on this, which is you have the administration doing everything it can to also pull that down. So it's another big factor in your favor for making this type of trade.
Yeah, and just real
quick,
just real fast. I actually have a really bullish note for people as well here. But kind of two things here. One is that yes, there was some foreign selling of bonds over the last 2 months because of the decline in the dollar. And as we've talked about before, when you have a big dollar decline, foreign reserves have to be rebalanced to keep currencies all trading within a relative range of each other. So if I've got money stored in U.S. reserves, then you're going to have a decline in foreign ownership of domestic treasuries to balance those currency reserves as it exists between countries. And this was a really interesting note this morning. Bob Brinker put this note out this morning on Substack, actually, and I pulled it over to Twitter this morning. But it says 1 year ago, foreign holdings of U.S. Treasuries were 7.99 trillion. The most recent data from the year shows a 10% increase to 8.82 trillion. There's not been dumping of treasuries around the world. The world is buying treasuries. And he's absolutely right, because it's a fun. So this whole de-dollarization and the end of the treasury, end of the reserve currency, all that is great narrative for a short-term decline in the US dollar. But again, you take a look at the long-term trend of the US dollar, it's very bullish. And that's not going to change anytime soon. And again, if you just take a look at, and again, this is just kind of a zoom in of the buying, but again, you're continuing to see foreign demand for treasuries because 70% of the world's transactions occur in the US dollar. So I have to own US dollars in order to transact currencies. But when we take a look at the dollar index, but yeah, we're about to trigger a buy signal in the US dollar. And when you take a look at this kind of short-term view of the dollar, this whole narrative that nobody wants the dollar, it's de-dollarization, it's certainly easy to get caught up into that trap. But once you start to zoom out on the dollar, you can really start to see that, hey, first of all, the dollar is just trading in a big giant trading range relative to other currencies. Is exactly what you would expect to happen. We're just, we've been at these levels before, and then you have a rally in the dollar, and it's just a differential between imports and exports, supply and demand between countries. And typically when you have very big drawdowns in the dollars, you're going to have fairly large advances. But if you put this onto a longer term perspective, and again, this goes, we go back, to 1970. The dollar just trades in a big sideways range. There's not any evidence going back to 1972 that anybody's de-dollarizing anything. We're just, balancing currency reserves around the world. And so you got to, this is why these narratives about stuff, and again, it fades in well with stuff. It's like, no, nobody wants the dollar, so you have to be long gold because it's a fiat currency. And there's no truth to that story at all, and the data shows that out. But it's a great narrative, and for people that want to sell gold as that's their business, that's awesome, right? It's a great storyline to sell gold. Peter Schiff is the champion of that. But and again, Bitcoin is another good example of this here. And I told you I got a bullish note this morning, but Bitcoin is now triggered a very nice buy signal. It's broken above moving averages. And this has been a risk on bet for financial markets, and it's doing very well here. So again, if the whole thesis is I want to own assets that are going up with the dollar, or assets that are going down, the dollar's rallying, and so is Bitcoin. So that shouldn't be the case. Bitcoin declined with the dollar decline. That should be if Bitcoin is the alternative to fiat, they shouldn't be tracking each other. But this is just simply a function of risk on bets. And so now you've got a very good risk on bet with the dollar and Bitcoin. So if I'm a trader and I'm looking for a short-term trade, I go long Bitcoin in the US dollar, and I potentially sell off gold at this point.
Okay, well, I mean, that's the playbook over the past couple of days, at least.
Right. That's if I'm trading, I'm talking about 24 hours to a day, right? The day, 24 hours a week. There's a very short-term speculative setup for a rotation between assets, and that's what we were just talking about last week. So, if you're a trader and you're really, you're short-term scalper, you're trading in 15, 30-minute windows, there's a really good setup for you.
Yeah, and I did have gold here on my list. You took a bit of heat in the comment section last week from your honest comments about what you thought about gold and gold's prospects. And I do just want to note that at first, gold continued its tear after we recorded Lance, and it zoomed up to a crazy high, crazy just in how quickly it got there. High of about $3,500 an ounce, at least in the futures market. It now has sold off as Bitcoin has caught the bid and the dollar has caught the bid, as you mentioned. And you had predicted that something like this was very highly likely going to happen in the short term, as did I, who again is a long time. I'm in gold for the long haul. But I knew that it'd run so far so fast that we were at a minimum going to see some sort of pullback like this.
And that was my comments last week, is that everything reverts to the mean eventually, and it's just and if you take a look at a long-term chart of gold, it regularly reverts to the mean. So just as an investor, our whole, and yeah, I made the mistake of looking at some of your comments, and it's interesting. People are so gravitated towards a thesis on an asset. And it's fine. It's fine to have that thesis, but you also have to understand that everything reverts to the mean. And so don't just, my whole comments are always, look, we own gold in one of our portfolios. We took profits in it last week because of the extension in gold. And when gold corrects back to a level where it's oversold, we'll add gold back into the, we didn't sell everything. We just trimmed it back to targets. We'll increase that target weight. So again, the whole thing is with investing in general, it's not about being in love with some asset and creating some thesis about why it can only go higher. Every asset is going to go higher over time, whether it's bonds or gold or Bitcoin or stocks, they're all going to go higher over time. The question is can I maximize my returns by learning to take profits and buying when it gets cheap? If I never sell anything, I can't buy anything when it's cheaper, right? And that's the whole point about managing money and managing risk.
And that's a great way to say it. Yeah. And so this is obviously, be a Vulcan. Don't get enamored of a narrative. But also, yeah, I mean, treat every asset like an asset, right? If it's rich, sell some of it, buy one that's undervalued, right?
Yeah, and the mistake that people make though is that every time we talk about that, they assume I'm selling everything, or that then I got comments like, "Why are you such a hater of gold?" I don't hate gold at all. I'm just saying it's overbought.
Right. Well, that's the point I was trying to make. Is you treat it like every other asset. You try to be very colorblind in terms of, the asset class. You don't really care what it is. It's just, is it fairly valued or not? And if not, I'll sell it. And if it is, I'll buy. Right.
Exactly.
All right. So a couple things. One, folks, for more information or deeper discussion on where the dollar is headed, I have an interview coming out the day after this one is released with Brent Johnson of Dollar Milkshake Theory. We actually talk a lot about the trade wars, and the big question I asked Brent, which is great discussion, is will China drink America's milkshake? And I will leave it there as a teaser. If you're interested in finding out his answer to that question, then you really should listen to it. It's great. Watch tomorrow's video. All right, and then to another point of yours, Lance, about narratives is for many reasons that we've talked a lot in past market recaps here, you have cautioned people from getting enamored in a narrative. If you do, I mean, it's fine to have a thesis for where something's, for what's going to happen. But if you do, then you really need to be tracking the data on that thesis, right? And that data you put up there about treasury ownerships by foreign holders, that completely counters the narrative that we're hearing, right? Oh my gosh, America has totally, broken its relationships around the world. Everybody hates America now. They're all dumping their treasuries. The dollar is going to go to zero. You look at those charts you put up. No, the dollar's just in its normal trading range. And lo and behold, more foreigners own treasury today than they did a year ago, right? So, don't let the narrative, don't let the salacious headline influence your thinking. Actually roll up your sleeves and do the data. And it's fine if you think, okay, foreigners are going to dump the treasuries and I need to be ready for when that happens. Okay, fine. But don't act on it until the data shows you it's happening.
That's right. Yeah, and this is so I wrote an article for today actually that's kind of leading into that as well, because again, I wrote this article because of our conversation last week about gold. And again, this everybody just assumes that because I'm, quote unquote bearish on gold short term is because it's really overbought technically, right? And as we were just talking about. So, but I wrote this article talking about being a speculator versus an investor. And, I kind of laid out this kind of table about the differences between being a speculator or an investor. And so you have to, this is where, again, if you're listening to this podcast right now with me and Adam, you need to determine what you are. Are you an investor or are you a speculator? If your time frame is days, weeks, or even months, I'm not the right guy for you, because I'm a long-term investor. I buy assets to hold them for a very long-term period. It doesn't mean that I don't manage the risk. And it doesn't mean that I won't sell stuff that breaks or doesn't work the way I plan. But, for instance, we've owned AbbVie for as long as we've been running the 60-40 equity model. We've owned companies like Microsoft and Google for as long as we've been running that model. Those stocks will never get sold entirely. Now we'll manage the position size, but we believe in the where they're headed. We believe in their fundamentals. We believe in the ownership of the company, et cetera. And that's going to always be the case until something changes. And then we'll change that view. But if you're a speculator, if your whole thing is to buy something today and you're going to sell it in the next few days, few weeks, or whatever, or you're just buying it because it's going up, you're in that speculator camp. And so you need to really be cautious about how you manage your money when you're speculating. So that's really what this article goes through, is talking about being an investor, what speculation means, rules to kind of follow if you are being a speculator with your money. And most people claim they're an investor. So when something's going up in price, I'm an investor. When it's going down in price and they should sell it, and they get trapped in the fact that now they've lost a whole bunch of money in it, well, I'm investing long term. So, and really what they're saying is, I'm just hoping it's going to get back to even at some point so I can sell it. Instead of managing risk, they always fall back to this being an investor thing, but they're really not. They're speculating in the markets. They're chasing asset prices, whatever it is. And it doesn't matter. Gold, Bitcoin, stocks, bonds, copper, whatever. These are all speculative assets, and they're all driven that way. And then I kind of lay out 10 guidelines from legendary and truly legendary investors: Jeff Gundlach, Ray Dalio, Seth Klarman, Jeremy Grantham, Jesse Livermore, Howard Marks. So kind of lay out some of their views about risk management. And again, when you read this article, which is posted on Substack at Lance Roberts, it's also on the website realinvestmentadvice.com. But every one of these rules, when you really come down and you boil it down to what made these investors great investors over the long term, is they managed risk. And they never got enamored with a headline or a thesis or some type of narrative. They just managed the risk in the portfolio for what it was. And if you do that, you'll just be a better investor over time.
Yeah, so I'm glad you brought that up. I had that on the sheet here. And I think it's a really it's a fun article to read. But there's a lot of timeless wisdom in there, folks. So definitely go read it. It's also making me think too. There was a interview I did earlier this week that it's been a really great run the past couple of weeks for videos on this channel. We've had a lot of viewership and just a reflection of how market volatility forces a lot of investors to have to start paying attention to markets, right? But there was one I did with a guy that most people probably hadn't heard of. He's a Belgian younger gentleman named Peter Slagus. And folks, if you haven't watched that interview with Peter, if you like, the nuggets of timeless wisdom from the great investors like Lance just showed us, you're going to love this interview. Peter basically is a disciple of the Buffetts, the Peter Lynch's, the Templetons, the Goodlucks, I mean, the Howard Markses, all the folks that Lance just mentioned there. And he runs I think it's the #5 most successful finance Substack in the world. It's called Compounding Quality. And he basically, just shares all of these lessons that he learns from his continued study of these greats, but he also manages a portfolio, very Buffett-like, and is just incredibly transparent about the process for how he screens, which ones he's looking at and evaluating, what he likes, what he doesn't like, if he adds it to the portfolio, why he's adding it, if he's removing it from the portfolio, why he's removing it. And so if you just want like a really good, deep discussion in how a value investor using the best practices of the greats approaches investing, that's a really great discussion. So, all right, Lance, real quick, I just want to go back to bonds for a second because I wanted to just get an update on credit spreads. I don't think we actually talked about that. Are they doing anything interesting right now? Because they were beginning to increase the last time we talked.
Yeah, they've increased a little bit, but they're calming down now after the last week or so. But again, they're still a little bit elevated. But again, again, credit spreads are going to increase with volatility. There's a very high correlation between credit spreads and volatility, which you would expect, right? So,
right. And sorry, but you'd also expect credit spreads to be widening when people are freaking out about the basis trade too, right?
Correct. Yeah. So there was things that were feeding into that, but now we're starting to see those calm down a bit. But the important thing is, and again, we talked about this previously, is that credit spreads aren't blowing out. They've risen a bit, which is what you would expect with a market decline of 20% and a spike in volatility of the 40s. You would expect to see credit spreads between junk bonds, which are a risk on proxy for equities, and the safety trade of treasuries. You should expect to see that spread blow out a bit, but it's not. They never really blew out to the point that said, "Oh my gosh, there's and this is why Besant was more not concerned about the basis trade, because the overlying spreads were remaining fairly well contained."
Right, right. And some of the folks too, who I think were saying, hey, gold, and I've asked this question of late when gold was just screaming, hey, is this just price action, or is this telling us that something systemic might be breaking? If it were something systemic that we're breaking, you would expect concurrently eventually to see credit spreads start blowing out. The fact that A, gold is sold off, but B, credit spreads sound like they're equilibrating at least a bit, shows that, okay, at least right now, there's nothing that's blinking bright red at us that there's something to really worry about.
Yeah. And look, gold could have a fairly decent correction here, a couple $100, $300, $400,
Sure.
whatever. And it'll be a good buying opportunity again. So if you missed out on your run in gold, then you're having an opportunity to buy some here a little bit cheaper. And this is just, as we've always talked about, just, be careful chasing assets. This is the one thing that the investors make the biggest mistake on over time. It's called herding, where there's just something is doing something. So, and everybody's talking about it. So they go buy it because it's going up in price. So they kind of get in with a herd. Herds tend to be right in the middle of a move, and they're dead wrong at extremes of moves, either up or down. So, this is where, be careful of chasing any assets that are going up in price really, really sharply, where there's this constant bid. Because if you get on the wrong end of that, you typically wind up losing money on that trade.
Well, that's classic investing. If you chase performance, whether it's in an asset or whether it's a fund manager, right? Mm-hmm. Oh, this guy killed it last year, I want to be in his fund next year, right? Is you are putting yourself at risk of reversion to the mean, right? Which is you can't. every year can't be an exceptional year. And in most cases, an outperformance year is oftentimes followed by an underperformance year to get you back to mean, right? So yeah, you don't just want to be blindly following performance, like you said. All right, I got a couple of just market forecasting questions for you here, Lance. So we're in this very headline-driven period in the markets right now for the reasons we mentioned earlier. So I just want to get your gut sense of how you think markets will, both the direction and magnitude of the market reaction under the following conditions. Trade war. What if it really actually gets prolonged here? Like the deals that, or actually, let me start this way first. Okay, if we start seeing deals getting struck, hey, we just finalized terms with India. Look, we got rid of almost all the tariffs, and they're going to take all our cheap natural gas, and we're going to take their whatever, right? If we start banging those out, how much juice do you think that's going to add to markets?
A good bit, because again, that tells me two things. One, the impact to earnings is not going to be nearly as great as expected, as you would expect with tariffs, right? So if example, let's just say $1 worth of earnings. And if I'm going to have a 10% tariff, I can whack 10 cents off that dollars of earnings. So now it's 90 cents. If it's 20% tariff, 80 cents on earnings. If that goes away, I'm back to $1. So all of a sudden, my valuation narrative becomes a lot better for stocks, particularly with stocks speeding up. So if, and my expectation, look, at the end of the day, Trump has come out and said, "Oh, I don't care about the stock market. This is about America first." He cares about the stock market. Trust me. I'm sure he's getting a lot of pressure from the banks, from donors, et cetera, about what's going on. And I think this has led to a lot of this reversal, the pause in the tariffs, the kind of the backing off. Hey, we're going to be nice with China. Those statements. That's him understanding that market dynamics do matter, that wealth effect matters. If you don't want to have an economy in a recession, you need to make sure that wealth effect is staying somewhat intact. It doesn't have to be perfect, but you can't destroy that wealth effect, because this is, Ben Bernanke 2010. Why are we doing QE? Consumer confidence. If I can boost consumer confidence through higher asset prices, I can keep the economy out of a recession. That's it. And so I think he understands that. So if he backs off of these tariffs a bit, and most importantly, starts announcing some deals, I think this market can stabilize.
Okay, let's take the contrary of that. The deals are just not, they're just not emerging, and the rhetoric with China just really goes south, right?
If it depends on the response. No deals are getting done. Market's probably priced in this idea of 10% tariffs, right? But if Trump comes out and says, "Hey, we couldn't cut a deal with anybody. We're all going back to these, here's my board, here's all these onerous, trade deficits," which I do not think is going to happen. I think that, my opinion only, I think he learned his lesson by following Lutnick and following Navarro, which he should fire immediately. If you want to give a boost to the market, fire those two guys, and market goes up. But if he comes out and says, "Hey, we're going back to those," this market's going to be down another 10%.
Okay. And let's say things with China just really sour. So in your 10%, are you including, just no deal with China? I guess even just not no deal, but like things go real sour. Like, okay, China slaps even more on, and it's like we're not only not coming to the table, we are flipping the table, throwing it in the wood chipper, saying this is never going to happen.
So China in isolation, or China as a part of the total?
Well, I guess in addition to deals not being announced with everybody else, right, which is what the expectation is, what if China just really signals that, under no way, shape, or form are they going to comply with any sort of new trade deal?
Yeah. Again, I still think you're down. I think that's all inclusive. I think you're
all
down.
inclusive. Okay. All right.
Look, it could be 15. You could be 10 to 15%, right? Just here's, if you really wanted to let's get really bearish on this for a second. So if nobody comes to the table, all the tariffs go back up, and we even put even more tariffs on China, and like trade just completely falls apart. that's going to be really bad. We could, in theory, that gets you to that 40 peak to trough, 40% correction. Now that sounds terrible. That's still a correction. That's not a bear market. 40% from peak to trough gets you back to your trend line from 2009. But I think at that point, you're going to start pricing in a whole lot of stuff. I think that, so one thing I'm writing about in this weekend's newsletter, talking about being a Vulcan, and you and I have discussed this previously, is this whole idea of bell curves. And when you start looking at a bell curve of probable and possible events, as investors, we have to invest on probabilities, not possibilities. So possibilities are everything falls apart, and that's a very small possibility, because at the end of the day, Trump is smart enough to realize that he's going to have to work himself out of that situation pretty quickly because of the impact of the economy. If we cut off $50 billion worth of trade with China, that's a major economic blow to the U.S. and companies here can't afford it. You can't offshore, reshore, onshore, whatever, quickly enough to offset that risk. And this was a mistake that Trump made. I think the whole idea of the tariffs and the trade war were okay. I mean, it's like, yeah, there's a lot of unfair trade practices between us and other countries. If you wanted to fix that, that was fine. But again, I think I may have said this before to you. He made a mistake by doing it first. I would have done tax cuts first. I would have cut spending in government first. And then I would have told all the US companies saying, look, in 12 months, I'm going to start this trade war. And so if you want to avoid the impact of that, you need to start reconsidering where you're onshoring and offshoring business, because these are the countries I'm going after, and this is my plan. And I would have laid that out and given companies 12 months to reshore their business or to move, because they just can't do that stuff overnight. I can't move my business from Taiwan to Vietnam or from Vietnam to Kentucky overnight. It takes months. And so he needed to give people time. And if he would have laid that process out, he could have also been negotiating behind the scenes before he ever got there with tariffs to get this stuff in place and really reduce that risk. But again, I'm not the president, so
yeah. So Brett and I get real deep into this in tomorrow's video. One point I made similar to yours is I think a communication mistake on the president's side was, I think you can say, hey, look, if the real objective here is to get China under control, and that needed to happen for whatever reason sooner rather than later, Trump should have been more overt with the American people about, hey, look, this is why this is a major strategic issue, national, security issue for us. And like it or not, this is the time we have to face this. And it may require, a rocky couple of months, quarters, whatever, but we're going to be better off for this, right? And I feel like the American people kind of got a little bit blindsided by this, and that they haven't been properly bought in, right? And look, administration may have all its reasons, or maybe other factors I'm unaware of, but to me, that feels like, I think the American people are understandably sort of, hey, we weren't really sure we were signing up for a massive trade war with China right out of the gate here, right? And had they been pre-sold, they might be more willing to have their belts tightened and be behind this.
Absolutely. And that was the other mistake that Trump made. Wall Street had given him the green light for 10% tariff.
For 10%, yeah.
And markets were bottoming. They were holding up just fine prior to the announcement, expecting that announcement to come out at the Rose Garden. If he would have come out and said 10%, this market would have risen right back up to probably towards highs. But the Wall Street had given him that green light for those 10% tariffs. But when he went off the rails with these other things because of Peter Navarro and Howard Lutnick, Wall Street said, well, basically, screw you.
Yeah.
So,
and to be honest, and I get into this with Brent, and really Brent gets into it tomorrow. Yeah. There's an argument that there is more method to that madness. I don't want to get into it here, but I understand why you think it was mishandled. Yeah. And I'm not saying necessarily that it wasn't, but I understand the case for why there were big numbers on that board. All right. So let me just round out this set of what ifs. Okay. On the flip side, on the positive side,
okay,
what if a deal with China is announced tomorrow, next week?
Market's going to be up 5% in a day.
Yeah, only 5%?
Well, we're already up 5 from the lows.
I know.
So, another 5%, you're going to be pushing up above moving averages. Yeah. Sure, it could be more. We could. I don't think we get back to all-time highs this year for a variety of reasons. And X trade, I don't think we get back to all-time highs because the economy is slowing down.
Okay. Okay. And that's kind of the spirit of where I was trying to get to with all this stuff. So thanks for getting to the punchline. Let me just ask you this too.
Hey, I could be wrong.
Okay. Thank you.
New highs this year could happen, right?
Yeah. You mean you're not going to put a personal guarantee on the fact that we're not going to see new highs this year?
I just, again, possibilities and probabilities. I just think probabilities are is we're going to finish this year, on the upside, 58, 5,900, maybe 6,000 tops.
Okay. I think I know your answer to this one, but again, playing what if a Ukraine-Russia peace deal was announced tomorrow?
I don't know if that has that big of an impact. I think for the Trump administration, I think it's a huge win if he can get that done. As far as the country goes, politically divided as it is, I don't think there's going to be a lot of people that are going to like it, because if a peace deal is done, it's going to pretty much be that Ukraine gives up the four areas that have already been annexed by Russia. So I think there's going to be a whole half of the country that's like, this is the worst deal possible ever, right? Because you just gave Russia a chunk of Ukraine. But I don't think that has a lot to do with the markets, and there's not a lot of. I think the markets will get a relief rally from it. So let's say a China trade deal gets us 5%, maybe a Ukraine deal gets us 1 to 2.
Okay. It's more or less what I thought you were going to say, maybe even a little higher than I thought you were going to say, because if I remember correctly, you've said many times the war, for good or bad, doesn't really impact the markets that much at this point.
Well, and the only reason I'm giving it an upside bias here, if markets were trading all-time highs, I'd be saying you get nothing from it. But given that sentiment's depressed, the markets aren't overbought, you're still oversold on some longer-term technical bases, you get a little bit more of a pop on just a thank God that's over, right, type thing.
Okay. And this may be similar, just in reverse, but let's say things there worsen. Russia and Ukraine say, oh, we're not talking anymore. We're running away from the table, and Russia amps up its war machine and starts going even further into Ukraine. That impact on the markets?
That's a little bit different story. So if it's just because you kind of gave me two scenarios. One is that we ain't talking. We're just
going. Oh, no. Just make it the worst scenario.
Okay, well, so this we ain't talking scenario. Markets don't respond much. It's because it's already what it is.
Yeah.
But if they go, screw you, we're gonna start dropping nukes in Ukraine, and then the whole world gets involved, that's a different thing.
Okay, well, sorry, yeah. Dropping nukes is gonna, no matter where that happens, that's gonna be terrible on the markets. Okay.
And that's, again, I'm gonna put that one out there on the very edge of the tail risk for the markets. I don't expect that to happen. I do expect that they'll probably get to some negotiation that is going to be a lose-lose for everybody. Ukraine.
Let's hope so. And let's hope we get to the negotiation, the truce. And sometimes they say, that's the sign of a good deal, is where everybody walks away feeling a little disappointed, meaning nobody took too much advantage of the other, right?
Yeah. But I think Ukraine loses the most, for sure. If there's a peace deal, it's going to involve them giving up at least the Black Sea, kind of the Crimea region where the Russian sub base is. That's going to go, and then some of the other regions that they've already annexed, those are going to go. So I mean, Ukraine's going to lose that. So I mean, and then not to mention the loss of life they've already had. So I mean, this is a losing deal for Ukraine, no matter how it comes out.
It will be a bitter pill. And look, I'm not a geopolitical analyst, but the president said something that I'm sure his detractors will say highly inappropriate. But he right now, I think he's pretty frustrated, from what I can tell, with both parties, not coming to the truce table in good faith. But I guess Zelensky, in his latest pushback, Trump said, look, Zelensky was saying, Putin's not making any concessions. And Trump said, his concession is not taking over the rest of your country. Yeah. Right. So, when you're in that position, you don't have a lot to bargain with, right? You can't say, all right, you know what, give me all these areas you've already, annexed, right? So forcibly annexed. So I agree. Ukraine, if a peace deal does get struck, is likely the line of control is probably not going to move very much from where it is right now.
Right. Yeah. And again, it's a very sad situation. It's unfortunate, that this got to where it is. It probably shouldn't have happened in the first place.
it's been a human meat grinder on both sides. I mean, it's just
It has been.
you think of the back to the John Kerry, what do you tell that last guy who's putting his life on the line to die for a failing war in Vietnam, right? Same thing on both sides. Hey, something that's going to get negotiated by men at a table, and it's probably not going to be very different from where things are today. How can you justify to the guys on the front lines to go out and put their lives on the line for another day, right?
But that's why we had during the Vietnam era. I mean, it's exactly why we had so many protests about the war. And unfortunately, American citizens who didn't fight in the war, they were taking their frustration out on the soldiers that were returning home, who were just following orders and doing what they were supposed to do. But it's very much that same situation where it's a bad deal. It shouldn't have happened in the first place. But it did, and getting out of this is going to be a disaster for the most part, and
Yeah.
there's no way to fix that, unfortunately.
There's a rant on that topic that we should have at some point. I've got a friend who mentor who served in Vietnam, and the scars from his return to the country, let alone all the horrible things that happened there in the war, and they still define how he
Absolutely.
thinks today. Yeah.
Absolutely. Absolutely.
Okay, so I've actually got something else for the rant today, though. And before we get to it, let's get to your trades. What trades, if any, have you made over the past week?
Didn't have done any yet. We kind of positioned ourselves for the rally this week, and so we've been enjoying that piece of the rally. We've been underperforming this rally just a bit because we have a short position, because we have an overweight position in cash. Our dividend equity model's at 30% cash right now,
Right.
so that's
But you get to play it safe because you have that buffer you talked about, so it's
right,
all
right, yeah.
good, right?
And,
Yeah.
and so I'm okay with that. I'm okay with the underperformance this week. And again, we'll probably, as soon as I hang up the phone with you, I'm probably going to add to our bond position a little bit, and add to our short position a bit.
Okay. All right. And of course, when you're on next week, you'll tell us what triggers you pulled.
Yeah.
All right. So for today's rant, I think these are interesting topics. So was listening to some of the latest executive orders coming out, and also just some of the discussions the administration's having. And look, Brent and I had to spend a lot of time in tomorrow's interview talking about this. The fact that we're talking about decisions that the current administration is making, in no way is it a partisan decision for or against. It's just this is the administration we have now, and these are the things they're up to that impact the economy, and it would be remiss of us not to track them or comment on them. So I don't know if you heard, but there's, I guess, a lot of talk about what do you want to call it? Basically, sort of providing some subsidy, some sort of subsidization or greater subsidization to families that have children, right? And this is you and I have talked about, Lacey Hunt's demographics or destiny, right? We've talked about how the birth rate demographics for America are not good right now, and the same for lots of other countries around the world. I mean, it really is becoming an issue of national security, right? And what's interesting is the whole Charlie Munger, right? Show me the incentive, I'll show you the outcome. If you're running a corporation, if you're running a country, what you really want to do is structure the incentives, align the incentives for the outcomes that you want, right? And one man's opinion, but I think we've had a lot of disincentives for household formation in this country, especially in recent years. The cost of living has just become so incredibly expensive that one of the big reasons why the birth rate is declining so much is people just literally can't afford to have children.
Yeah.
There's some other cultural things going on that I think also hamper it. But just economically, we've made it harder and harder for young families to form and raise more children, right? If they do form, they're having one kid, right? And so we need to ask ourselves as a country, hey, look, if that's a key trend of ours that we need to reverse, how are we going to do that? And to a certain extent, there's a rant I've probably been thinking about having you for a long time, Lance, about sort of marriage as a contract, and what is it, not just the relationship between the people, but like what benefits do we bestow married couples and whatnot. And at the end of it, at the core of it, to me, it makes sense for it to really sort of be about or reward most family formation and child rearing. And again, this is me playing Emperor of America, where I need to win the risk on the risk board, right? I need to have my populace growing, right?
Yeah.
And so I'll stop talking in just a minute to let you chime in, but like, there are benefits you get from the marriage contract, right? There are economic benefits you get from the marriage contract, and I get that. I'm for that. And at a minimum, I think there should be things like, well, if I'm married to somebody, that gives us certain rights. If I'm incapacitated, they can represent me. If I die, they can take over my assets. There's the person I love. I want them to be taken care of, that type of stuff. But in terms of like the state saying, I'm going to give you benefits, whether it's tax cuts or other things, I think those should be focused more on family formation, on actually having kids, right? And we do give a child tax credit and whatnot. Obviously, it's not making a big enough difference right now.
That's too
Yeah.
small.
So I guess where I'm going with this is I'm kind of for. I think it's still being discussed. What we could be doing in this country. I'd love to see what other countries are doing. I'm not an expert on this topic, but I am a big fan for saying, what are the things that we can do for families as they start adding to their family, right? How do we make it easier for people to have and raise kids, to be able to afford to be able to do that, so that we have a populace to do all the things that we need our populace to do? And of course, you got to put parameters in there, right? Like, there's a big debate going on. Should this be only married couples? Should it be anybody that has a child? And you have to ask questions about, well, if you're encouraging sort of single parent formation, we have a lot of data that shows that those kids have a lot more troubles than kids that grow up in a nuclear family. I don't know the hard answers. I don't necessarily want to be, wicked, super structured and top down about this, but you want to make sure you're not providing the wrong type of incentives, right? So there's a whole big discussion to be had here. Gay marriage, hey, have at it. If you're having kids, if you're going to adopt and add to the populace, great. You get all the same benefits. We should be just real clear on what our priorities are. And I do think that probably the core priority is how do we raise functional, healthy new citizens at a birth rate that will keep the population and the economy sustainable.
So it's actually quite interesting, that the Trump administration just announced last week that they were talking about some idea about like providing like an incentive like $5,000 or whatever to have children, because the demographic issue is a major issue. If you don't, as Lacey said, previously, we've said this for a long time, demographics are destiny. If you don't grow your population, you don't have new workers to replace retiring workers, and it becomes an economic problem. So what could you do in theory? And there's lots of sliding, there's lots of slippery slopes when you start talking about this stuff. Again, as you're talking about, it's like, well, gay marriage versus regular marriage versus single parents. So you got to resolve all that, whatever that's going to be. But ultimately, you just want to provide some incentives to have children. And one things we know, some things that we do know just from the data, that, for instance, social media has led to a big decline in the birth rate, because people are not getting out into the world. They're not meeting. They're not not hooking up like they were.
These are some of the cultural things I talked about. Yeah.
Yeah.
Exactly.
So,
yeah.
There's I saw a very encouraging report yesterday that young teenagers are now starting to turn off their social media. They're starting to discover things like going outside is actually good. It's fun.
Have you heard of that term, touching grass? I like that. That's actually becoming a thing. Hey, go out and touch some grass. Yeah.
Exactly. So, and look, this younger generation, they're now starting to discover new things. That there's a challenge going on right now, Adam. I don't know if you know about this challenge, and I'm not even sure you can do this challenge. You already try this on your own, but it's to take a pen, put it on a piece of paper, and write your name without lifting your pen off the paper. This is the challenge. It's called cursive, but it's a challenge. But yeah, so the younger generation, they've got some real impediments to growing a family, meeting a family. Social media is certainly a deterrent from that. One thing we need to address is we need to address divorce laws. The reason is that there's a lot of people in the upcoming generation right now. They've grown up in an environment where 50% of parents are divorced. they've had to live. My kids are a function of that as well. I'm divorced. My wife is divorced. We got back together. Fortunately, our kids were very young when we got together, so they don't really know what it's like to have divorced parents, other than they've got these other parents that they have to go see on a regular basis. So, but one of the drawbacks that people are starting to realize is that you get married to somebody, you have kids, and then the divorce law is very cut and dry. You get divorced, the wife gets half your money, you've got to pay child support, even though if they're not a good parent or not, doesn't matter. That's just the law. So there's a lot of people just opting not to get married, not to have that risk. And we need to revisit divorce laws and come back to say, look, what if both parents are working? And that law came into effect when women didn't work. They were the stay-at-home mom. They raised the kids. The father worked, and that was it back in the 50s. That's not that way anymore. Both parents are working now in most cases, and one parent is not just because the mom is the parent doesn't necessarily mean she's the best parent for that child to be raised by. So I think we need to revisit that and at least come up with a potentially more fair and equitable situation in terms of divorces, to allow people to have the ability to recognize that they've entered into a bad relationship, but can exit from it with a reasonable settlement between the parties, and not just kind of this cut and dried mix that goes on, and particularly in states like California, where we have alimony on top of all that, right? So
Right.
it becomes very burdensome. So my point is, whether you agree with divorce laws or not, it's irrelevant. So the point is that people have figured that out, and young men are saying, I'm just not going to get married because I don't want that risk. And people are, and again, we've made divorce way too easy. It's too easy, and this is the next solution. If you're going to enter into the marital contract, it cannot be as easy as it is to just simply walk away from it and say, I didn't like the way you dressed this morning, so I'm getting a divorce. We've made it way too easy. There used to be a very big stigma back in the 40s and 50s about getting divorced. I mean, if you were divorced, you had like a big scarlet A on your chest, right? And nowadays people are divorced like, oh, you're divorced? Yeah, me too. Everybody's divorced. And so it's just way too easy to be divorced these days. And that breaks down that whole nuclear family, and again, makes it much less attractive to be to raise children in that type of environment, when it's, and again, going back to younger men, they're looking at this going, it's just too risky to get married, potentially lose half my stuff, and just because somebody gets tired of somebody or whatever and walks away from it. On the positive side, things that we could do to potentially enhance marriage would be to make kids tax deductible. And I don't mean just tax deductible in terms of just you get a child tax credit, but you can basically write off your expenses, school taxes, school clothes, housing, part of your housing, so raising kids, because a child tax credit of $3,000 a year doesn't cover the cost of the $250,000 that it's going to cost to raise that child to 18 years old. So, people are financially struggling to make ends meet. The cost of living has gone up, obviously. And so you're going to have to provide some more incentive to make it more advantageous to take that step to have multiple children. Just having one child isn't going to do the trick. If we want to solve our demographic problem, we need people having at least two children, if not more. And so we need to make sure and try to incentivize that action through some type of tax efficiency, some type of support structure that gives people the reason to actually go out and have children. But it's so many things that could be done, but you get my point.
Well, exactly. And what I'm hopeful of is that discussion and brainstorming, may hopefully start here, and we may come up with some really interesting ideas. You mentioned the idea of the 5K per child that was floated. And look, personally, today's day and age, 5K is not going to last very long. What's the cost of raising a kid? I mean, it's like on average, like $500,000 or something like that, right?
The 5K doesn't even cost the birthing cost of the kid. So
yeah, exactly. One idea I've heard that, it's a big idea, but it's interesting. So, we've heard no tax on tips, no tax on Social Security. So I've heard no income tax on families that have children in the home.
Yep.
Right. It's a big idea. It takes a little while to get your brain around it, but maybe, right. And again, these all come to incentives, right? And I'm sure there are ways where people can try to game this stuff. So you got to try to ring fence. How do you prevent abuse and all that type of stuff? But at the end of the day, like what are tax cuts? I mean, tax cuts are there to provide incentives, right? And that's reasons why we have, all sorts of real estate projects that get built because the government wants to incent stuff like that. Okay, great. And I'd love to have more of whatever, we think we want. But at the end of the day, demographically, if that is our destiny, the lowest Maslow hierarchy of needs, what should we be subsidizing, right?
Yeah.
Well, having people to
Yeah.
continue this country tomorrow. So anyways, one last point on this, which is there was an executive order that went out the other day, all about creating, it's basically assembling a task force to come up with a educational plan for teaching kindergarten through high school, I guess, or whatever, AI, right? So it's basically how do we revamp our education system with AI to make sure that kids are learning how to use AI, if that is going to be the core transformative technology of the next generation. How do we make sure we are raising kids that know how to use it to both learn, but also compete on the world stage, right? So, you look at America and how we score, say, on math versus lots of other countries, and we have completely plummeted over the past 40 years or so, right? So to me, this looks like this looks like a 40s and 50s era, revitalization of, hey, look, we're going to start taking education very seriously, and we're going to start, creating this national focus when kids are real young to try to set up our youngest children for success on the global stage tomorrow. And the libertarian side of me doesn't love the government like getting too top-down command and control about what we have to do. But at the same time, when you look at countries, especially in our own history, and we were talking about this, I think, the last time around World War II and the space age, about how much progress we made because we were so focused around common goals. I think we've lost a lot of that. We've lost a lot of that both on the national stage in terms of like the government setting requirements and goals for the populace to try to hit, but we've just lost it culturally. We were very much sort of collectively driven for the common good when we fought World War I, when we made it through the Great Depression, when we fought World War II, and even through the space race, as you talked about. But then we slipped in during that period to the me generation, right? And it was all about what's in it for me. We sort of ignored Kennedy's call, don't ask what your government can do for you, ask what you can do for your country. And the part of me, there's a little bit of an optimism as we connect some of these dots here about like, all right, well, let's really focus on creating the populace of tomorrow we need, and then B, arming them with the tools and the advantages they need to succeed and to thrive.
And you should be encouraged about this. So, first of all, the Trump administration is doing the right thing right now, which is getting rid of the Department of Education.
Yeah.
And
sorry to interrupt you. I'm going to let you run here. Again, folks, this is not a Trump loving thing. I'm just talking about some of the considerations to repair some of these big deficiencies that we may have the door opening here. So sorry.
Yeah. So no, and to your point, right? You said as a libertarian, you're not a big fan of the government overseeing education, and that is something that Trump is moving towards right now, is trying to get rid of the Department of Education. Ever since we established the Department of Education in 1982, our education quality has dropped sharply in this country. And for instance, in Texas, we are very close. It has already passed the House in Texas, and it's coming up for vote in Senate. It looks very optimistic. This is going to get on the desk of Governor Greg Abbott here soon, which is providing school choice in Texas. What does that mean? Well, first of all, getting rid of the Department of Education returns to the states. It returns education back to the states, which is where it was prior to 1980, when we had a very excellent school system nationwide. Back in the 60s and 70s, we were ranked in kind of the top educational brackets back then, focused on math and science and those type of things. Well, what school choice does, and this is going to be very interesting and something that maybe could become a model for the country, is that it basically allows parents. So for instance, as a parent, even though my kids are out of school now, I still pay school taxes every year. And that goes to subsidize public schools. even if I don't have kids in school,
Right.
right?
People
So
hate, but again, I think that's one of those things where, hey, part of being a citizen is to
but hold
invest
on.
in the things that are a priority for the country, right?
Well, right,
Yeah.
yeah, but I'm subsidizing failing schools,
Yes, which under the current system
right?
is frustrating. Yes.
So what school choice does is it allows me to take part of my school taxes and I get to direct it to the school that I want. And
Right.
I can now use my school tax money to subsidize if I want to put my kids in charter school or private school, whatever it is. I can now use my, rather, like right now as a parent, if I wanted to send my kids to a private school, I have to pay for that and school taxes, which are going to fund failing schools, in the Houston area. So this gives us an opportunity. Now, what this breeds is competition within the schools, because now if I'm a school district and I'm the administrator of that school and I'm making $350,000 a year, if I want to keep my job, I better keep my attendance up at that school, which means I better start providing the type of education that parents want to send their kids to. And so instead of me sending my kids to a private school, I can send my kids to public schools. So for instance, when my kids were very young, I lived in Houston. I moved out of Houston. I moved to a suburb called Katy, Texas at the time, because it had some of the best public schools in the state. And their education system was excellent. And I literally moved my whole family out to Katy just so I could send my kids to public school because they had a really good school system and it worked well for my kids. So now my kids are all in college and they're doing great. So, but this providing this ability to have school choice all of a sudden changes that dynamic by inserting competition into the school system, which now incentivizes schools to increase the amount of education or the quality of education they're providing so they can attract students and get more of that money, which is should work out very, very well. And I'm hopeful that that will get passed here sooner than later.
Okay. Well, again, folks, thanks for hanging with us on this exploration here. We're having to, I feel like I've got to be treading a little bit gingerly here because there are lots of landmines that, people could react to about, well, the current administration's doing this and therefore it's political, you're taking a political side, or I realize some of these topics, people have very different opinions about school choice too.
Yeah.
But I love the fact that hopefully we are focusing on the outcomes we want. And then the discussion is okay, what are the best incentives we can put in place? Perhaps like increased agency and competition in the education system on the state level, as you're saying, Lance, to better get the outcomes we want from the right incentives. I also just want to note too, you're talking about Texas. I just noticed that Governor Abbott has said that he's going to create a Texas Doge
Yep.
commission.
It's actually already passed. He's already
It
done
already
it.
passed. Okay,
Yep.
great. So I do predict you're going to see a lot of that going across in other states, right? And again, Doge is another one of these things that's charged, politically charged.
Just to be clear, Elon Musk isn't running it. It's just a Department of Government Efficiency to focus on expenditures in the state of Texas.
And that's exactly where I was going to go. Whatever you think about Elon Musk, whatever you think about the current administration, this concept of, hey, we need to hold government to account in terms of, is it doing the right things with our tax dollars, right? Are we getting what we want out of our tax revenues? I think the country has just woken up and said, look, how can we be against this idea, right? And it's nice that you're sort of beginning to see it infect these places. And just to connect one dot, Lance, I'll let you talk next. There's so many sectors out there where education's a great one, right? Where we've seen huge growth in administration, right? The ratio of administrators to teachers and pupils, right? Where a Doge type effort is a great thing to say, okay, look, well, has that been a good development, or do we have a lot of administrative bloat here that we can remove and take those same dollars and spend them much more directly on learning on the pupil or empowering the teachers to teach better or whatever, right? And then AI is going to unlock a whole bunch of things here too. And this is a rant for a different day, but like if it's a one, here's my opinion, if it's a one-to-many scenario where teacher front of the classroom showing a whiteboard explaining a concept, do we need tens of thousands of people doing that across the country? Or in the age of AI and digital media and whatnot, can we find the best teacher to be helping describe to students how to understand key concept X? And then the role of the actual teacher in the classroom is more answering questions and helping kids with the homework and the practical application of that. So does it enable us to bring the best instructors to students at the lowest possible cost, and then really use the live teachers for much more of the practical application? I mean, there's just a lot of things that could be opened up here.
No, there's if you go online, as an example, and you search, and here's actually kind of a fun thing I've been doing with Chat GPT. I've been putting in prompts into Chat GPT about, how to make me think more critically, how to, improve my abilities in this particular area, those type of things. And so, and what it's doing is it's drawing from all these resources from Harvard and Yale and the great thinkers of our economy, et cetera, and bringing in those lessons about, things you can do to improve your discipline, to improve your thought process, to, things I've never really thought about, just, habits to create. And you can really use that tool to really start, enhancing your abilities. And, if you go online, there's free, we talked about, the problem with phones before, which is, we have all this knowledge. You go on this phone, there are reams of, classes that you can view from Harvard and from Yale and from Stanford, that you can go take a class on quantum physics or whatever it is.
For free.
It's amazing what's out there. Then, and we're just sending mean tweets to people we don't like, right? And I'm commenting, well, Lance hates gold. Well, there you go. There's your time. You could be figuring out, the basic lessons of black holes. But yeah, the benefit to our kids going forward, if we use this properly, is going to be amazing. We're going to have really, the ability for our kids to be just so much smarter than we could ever imagine. It's almost mind-boggling. But again, what I was going to say was a second ago, we're attracting a lot of business. We're bringing a lot of companies in from California is a good example. Companies are moving here left and right. And the administration is really focused on trying to do a lot of things, from, school choice to getting rid of property taxes to, lowering the cost of taxes and tax. We don't have an income tax in the state of Texas. So that's all being very attractive now. And they're very focused on creating a very strong environment to build out education, business, being very business friendly, and really being the state that people want to be in, so that you can grow a business and grow a family effectively, and reasonably. And so, they've been doing a lot of work over the last 4 or 5 years in particular in that direction. School choice is the latest. They've been working on school choice now for the last 6-7 years. And it's been blocked by Democrats over and over and over and over again because they don't want school choice. But finally, this is the first year that it's actually passed the House and has a really good shot of passing the Senate.
Well, I got to tell you, Lance, as a reluctant Californian who just paid his tax bill here and is thinking, oh my God, I got to get out of here. Texas is looking increasingly attractive, although I got to say, you got to somehow get me over those, 110-degree, stretches for months.
Look, everything has a detraction. There's no perfect anything. So
all right. Well, look, thanks for going on this.
Weather, but you got the taxes. You got no taxes, but you got the heat. So
yeah, I got to say, you stay in California because you're like, okay, the climate's just so great. I mean, there's a lot beyond the craziness of the governance and the cost of living. There's so many great benefits here. But then when you pay your taxes, you're like, whoa, is it really worth that?
So could you imagine if we could take Texas and then just make it California? The entire country would live in California.
Well, part of me sort of feels like, if I just really want to be beloved by my progeny, I just should buy the nicest property here I can and say, look, it's going to be terrible for the next couple of decades, but at some point, California is going to go through its own reawakening where they just say, look, we let things get way too crazy here. They start adopting a lot of those types of policies you're talking about, and then it's going to be heaven.
Yeah, it will. And then everybody will move out there.
And everybody will rush back in. Exactly, yeah. All right. Well, look, thanks for going on this exploration for me. It was hard because there were so many other things I wanted to go drill down on with you. So we've probably got 6 or 7 rants worth of material out of that one in the future. And folks, again, thanks for listening to us expound on this. But it's fun actually to be, talking about things that may be laying the seeds for a much better tomorrow for society. And look, I don't pretend that we've got the best ideas at all, Lance, but I'm hopeful that the brainstorming in this discussion begins to the acceleration that we seem to be seeing nationally continues.
Yeah, no, but look, I am super optimistic about the future. I mean, there's a lot of people that are very sour on the future. America sucks, and we're going to lose our dollar reserve status, and everybody hates us. And I don't see that at all. I travel a lot around everywhere. I've spent a lot of time in other countries, and I have friends all over the world that I talk with on a regular basis. And there's those views are not widely held at all. And in fact, if you just kind of take a look at where we are, I think we're in a much better position to have a much better future than a lot of people are thinking, especially with AI and the stuff that's coming is just going to be absolutely phenomenal.
Yeah. I'll just end with this tease, folks. To Lance's last point there, watch tomorrow's video with Brent Johnson. All right. Well, look, folks, if you think one of the most important steps for building a better tomorrow for the world and all of its citizens is to continue watching Lance Roberts on this channel week after week, please let him know that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Lance, that's probably the biggest plug I've given you yet for one of those tie-ins there with the like button.
Yeah.
And folks, look, to our whole discussion about this being highly likely to be a very volatile 6 months ahead here, one that could shake a lot of people out of the markets. It's going to be frustrating, to use Lance's term there. If you're looking for guidance on how to navigate your capital, hopefully safely through that, and maybe be well positioned at the turn when the next bull cycle starts, highly recommend that most of the people watching this channel work to get well positioned by leveraging the expertise of a good professional financial advisor. If you've got a good one who's advising you already through this, great, stick with them, especially if they're coming up with a personalized portfolio plan for you. But if you don't have one, or you just like a second opinion from one who meets those criteria, consider scheduling a consultation with one of the financial advisory firms that you see with me on this channel week in and week out, perhaps even Lance and his team there at RIA. To set up one of those consultations, just go to thoughtfulmoney.com, fill out the short form there. It only takes you a couple seconds to fill out the form. These consultations are totally free, and the firms will reach out as soon as you fill out that form. Lance, my friend, another great week. We went a little bit long this week, so I'll wrap it up here, but I'll give you the last word as usual.
Absolutely. Well, next week I won't be here, so I will have to unfortunately leave you with Michael Leibowitz to talk about whatever y'all want to talk about next week. But I'll be in New York doing a live interview with Fox Business and Charles Payne. So,
all right. Well, look, say hey to Charles for me personally, and I'm sure a lot of people will miss you, Lance. But I'm sure a lot of people are happy that Michael will come on here. We always get
yeah,
a lot of people.
I've seen the
Yeah.
comments.
Yeah, it's not a detraction of you. It's just that they think that you've got a good partner as well. So anyways,
Yeah.
another great asset on the RAA team side. All right, buddy. Well, look, thanks so much. Great week. Everybody else, thanks so much for watching.